Everyone, we're going to get started. Welcome everyone to our annual IPO Bootcamp. We have an amazing audience today. We're so grateful that you all could come and join us today. We have a series of panels and speakers to go over kind of current trends in the IPO markets, as well as some personal experiences from folks on the industry side that have recently been through IPOs. So we have a really great day. We're hoping we can make this interactive, so feel free to ask questions during any of the panels or the speakers, or also grab us. We're going to have a series of breaks so that we can talk. We have over 200 external folks registered, so we're hoping that this will be a great networking opportunity for you as well with some of your peers. So again, thank you for coming. I'm Jen Plotnick. I'm an audit partner in the Boston office. I run our early stage life science practice here locally and co-lead our national early stage life science practice with another partner in California. So,
thanks, Jen. Excited to see such a packed room today. I think we've got a jam-packed agenda, as Jen said, so I'll try to make my introductory brief. But Greg Stamm, a partner here in the Boston office in our audit practice, working both technology and life sciences space. Excited to share my recent experiences in the S1 registration process and IPOs, and co-lead some of our panels today. With that, I'll kick it over to James.
Yep. So my name is James Cohane. I'm a senior director of sales here at KPMG. My focus is primarily high growth private companies in New England. So all of you are my target market. Thanks for coming. Yeah, just to echo Jen and Greg, we're excited about the turnout today and excited to have some great partners in Nasdaq, JP and Goodwin. And as Jen mentioned, we have a couple of folks with recent IPO experience, which will be helpful. In terms of the agenda, we just went through the registration and breakfast. We're into the opening remarks. I'll keep this brief. Then we're going to have a panel on pre-org meeting considerations, followed by post-org. Then we're going to have a 15-minute coffee break. Then we're going to ask the folks from JP and Nasdaq to talk about the IPO market. We're going to have a fireside chat with folks from Klaviyo, Numora, and PepGen. And then one of our colleagues, Francois Chadwick, is going to offer a closing talk, 5 minutes of closing remarks, and then we'll have an hour or so networking lunch. So lunch will be served around 12:20. All right. So I'm going to try to set the stage with a couple of slides. Each year we do this event, I put together some slides, and it's often helpful to look back at what we were thinking 12 months ago and compare them with what we're at, what we're thinking today. 2023 has been pretty lousy with respect to IPOs. But, and this is compared to 2022 when everyone was crying and saying that there was no optimism, we are relatively optimistic for 2024. I was talking to the folks from JP I think 6 weeks ago, there was more optimism than there is today. But there is some optimism. There are signs of life, and we weren't saying that 12 months ago. This next slide lays out US IPO market activity for the past several quarters. The takeaway here is that activity is up relative to 2022, both in terms of number of issuers and IPO proceeds. But it's against a low bar. 2022 was pretty abysmal. When you compare it to 2021, significantly down. The thing I'd say is that 2021 was a pretty remarkable year. Orders of magnitude bigger than you typically expect. So, we're doing okay, not great in 2023 year to date. This next slide talks about U.S. Venture capital funding activity. This is a leading indicator for the IPOs, and they also track somewhat similarly. Takeaway here is that things are relatively slow. For 2023, you'll see 2021 looks pretty ridiculous. That big bounce. We're at where we were kind of in 2020. Anecdotally, I'd say that we continue to see locally and nationally good companies can raise big A's, B's, and C's and D's. Some of the folks in the room, you guys have done that recently. I would say that the bar is higher. If you're a pre-revenue biotech, you're not raising a $100 million A just on an idea. You need data. Similarly, on the tech side of things, good companies are raising money, but the valuations are significantly depressed. This is looking at Boston specific. So we've only had 3 IPOs year to date. Again, pretty lousy. Those are Klaviyo, which is a sizable tech company. Like I said, we're going to have someone from Klaviyo speaking on our panel. Neumora Therapeutics, another biotech. We're going to have someone speaking on the panel. And then Apogee Therapeutics. So one tech and two life sciences. On the bottom chart, we've laid out IPO activity from 2020 to year to date. You'll see that the 3 deals that I mentioned in the 2023 year to date figure. You line it up against 2022, 8 deals. 2021 was a monster year with 32, and 2020 was pretty good with 27 deals. One of the other takeaways here is that Boston is a remarkable life sciences town. It's arguably the best in the world when it comes to early stage life sciences company formation. It's a good tech town, but 90% of these IPOs were in the life sciences space. This slide I stole from Jordan at Nasdaq. They have a unique seat at the table. He knows sort of what the pipeline looks like in terms of upcoming IPOs. This is showing the number of companies that want to go, both traditional companies, so operating companies in the blue, and then SPACs in the green. The takeaway here is that a lot of companies want to go, right? They're just hoping that the market conditions improve. And Jordan will elaborate on that when he speaks. Finally, this chart is showing a listing of companies that want to go by market. This isn't Nasdaq data, it's Renaissance Capital data, which it is what it is. It's not the best data, but what we're trying to show here is that Boston has some companies that want to go. It's not San Fran with 91, it's 17, but directionally, Boston's a good IPO town. We just need market conditions to improve. So with that, I'm going to turn it over to Greg, who's going to lead the panel on pre-org meeting consideration. So if you're on that panel, please come on up.
Is your name on there? Yeah. I can stay. All right. Well, thanks everyone for being here today. I think we got a great panel here. I'm just going to start things off with maybe if we can just go down the line with starting with Jen, who's given us a bit of a brief introduction, but just talk about who you are and how your company plays a role or your practice plays a role in the IPO process.
Sure. As I mentioned, I'm Jen Plotnick. I'm an audit partner here in Boston, and I support life science companies, mostly early stage life sciences, either preclinical or clinical stage. So obviously, as the external auditors, we are supporting the team through the IPO process, preparing typically upgraded financial statements. So a lot of times companies, before thinking of an IPO, will be preparing private company or AICPA financial statements. So oftentimes those need to be upgraded to PCAOB audit standards. So we're working kind of through that process, as well as helping the company through drafting and reviewing the S1 and preparing all the filings. So that is typically our role as auditors.
And I'm Sean MacGregor, and I'm the Executive Director at JP Morgan, sitting in the healthcare group. I work with emerging growth biotech companies, both public and private. Our role in an IPO is typically as lead underwriter or book runner, in which we help companies through the drafting process and crafting their story for investors, working with them through valuation, both looking at trading comps and precedent IPOs, and then working with them as they have meetings with investors, getting feedback from investors, and really helping to define what range to launch an IPO at, how to work through the roadshow process, and really understand timing considerations. And in light of the current market, the volatility, et cetera, we're also working closely with companies as they explore dual track options.
Yeah, thanks. Good morning, everyone. My name is Brian Scudder. I'm a managing director with KPMG in the accounting advisory services practice here in Boston. Our primary role is to help our clients really understand the broad impacts of an IPO and how that impacts the broader organization, as well as help stand up teams and operations so that the business can operate successfully on day one.
Hi, I'm Jackie Lewis. I'm in the tax BTS group here. I work very closely with the advisory and auditing group to help companies to IPO. A lot of tax due diligence is needed in advance of the IPO, and we work very closely with the groups to help companies as they're on their IPO journey.
Hey everybody, my name is Bill Collins. I'm a partner in the life sciences group at Goodwin Proctor, law firm just about a half mile that way. I work with biotech and life sciences companies at all stages, so pre-Series A all the way through multi-billion-dollar public companies. As company counsel, principally, I work closely with the company management team, the finance and legal teams to quarterback the transaction, not to use a sports metaphor so early, but and also help advise as from a strategic standpoint at the board level whether an IPO makes sense versus some other go public transaction, a dual track approach, et cetera. So good to be here.
Great. And Jordan Saxe from Nasdaq. I lead our East Coast capital markets team, working with companies that are usually around 12 to 18 months before an IPO, thinking about path to going public and all the preparation that goes into it as far as the IPO readiness, the IR advisory. There's a lot of comms and marketing initiatives that go into not only day one, but then once you're public, you face an endless series of quarters. So we help companies kind of think through what that looks like.
Thanks, everyone. And with that, maybe Bill and Sean, you want to talk a little bit about things to think about in choosing the IPO path and maybe some alternatives that companies consider if they don't go down the IPO route?
Sean, you want to go first?
Yeah, sure. So in terms of other options that biotech companies may consider, reverse mergers are a typical option that private companies are considering today. There's a number of, in the biotech world, there's a number of cash shells for companies who have had, failures or missed data, and now their mandate is to explore strategic options in which they've put a for sale sign on the company and they've put out process letters for private companies to put in bids. I think one of the main considerations there is what type of synergies private companies have with some of those public shells from a pipeline or technology perspective, as well as any shareholder overlap. I think the key thing that's underlying IPOs today is insider support. So even if you're considering a reverse merger, you need to make sure that your insiders are supportive, because typically you'll do a pipe raise concurrent with a reverse merger. And as mentioned before, companies are also considering a sale as well. And that's part of the dual track process in which they're looking to go out to strategics, either to educate strategics, to understand how they view the company, and potentially view a sale and derive some competitive tension vis-a-vis the IPO timing. So those are some of the typical options that companies are exploring hand in hand.
And on the reverse merger front, to piggyback on what Sean said, so look at synergies, you look at overlap. There might very well be none of those things. So then you look at cash and liabilities, and what would it mean to step into the shell of a former operating company, and what that means from a diligence standpoint. The other thing I'll note, this SEC in this political climate, we'll talk a little bit about that at various points on these panels. They treat reverse mergers like an IPO, and so from a timeline standpoint, there's no appreciable benefit to going reverse merger, but you are a little less beholden to market conditions. So it's really a question of, okay, is this a way for us to get out to the capital markets without having to rely on insider support to support a $100 million IPO, or being beholden to waiting for that perfect window, which might never happen, right? So, but it's all against the overlay of what your data cadence is, catalysts, what your insider lineup looks like, and what kind of liquidity and financing plans that your board's looking for.
And now, how about from a SPAC option? Has that become a four-letter word these days? A little different than the environment we were probably sitting in here, this room, 3 or 4 years ago.
Yeah, I think we still have a hangover from 2021 SPAC mania. I mean, it's been a long time since the word SPAC's been uttered in any of my boardrooms. I mean, look, for some companies in 2021-ish, 2022, it made sense. But it's just not something you see a lot of. What you see actually more and more these days are SPACs being unwound, right? That didn't find the right target and have decided to give their money back to their investors and move on with their lives.
All right. And Sean, can you talk a little bit, you mentioned it earlier, but crossover investors and what their role is in the IPO process?
Yeah, I think just touching on one of the key themes for an IPO in order to ensure success is having that insider support. So having the insiders speak for 100% of the IPO raise. So I mean, that may require private companies doing an additional round with those crossover investors. Those are key healthcare institutional investors that diligence the company, that investors will rely upon in the IPO process, and also will provide support from a dollar perspective in the IPO. So giving the company, the board, additional investors the confidence that the company will be able to be successful in an IPO. And I'd say that the crossover investors are about, I mean, it's a small group, maybe 20 to 40 in the healthcare biotech space that you're seeking to bring into the company. Within the current market environment, doing a crossover raise can be lengthy and time consuming. Investors are doing a lot more diligence than they did, say, in 2020, 2021, when the market was a bit faster. So investment committees just require more diligence. That's extending the timelines for these rounds. Rounds are getting a bit smaller because crossover investors also play in the public markets with valuations depressed. They'd rather play in some of those names in which they have some liquidity as well. So it's a lengthy, time-consuming process, but ultimately it's worthwhile and necessary for those companies who are considering an IPO.
All right, and Bill and Brian, you want to talk a little bit about how the Jobs Act and FAST Act impact the IPO process?
Sure. Maybe I'll knock off a few of the key legal points, and then Brian, you can take it from there. So, I mean, the term we used around Goodwin back in 2012 when the Jobs Act first hit was, we called it a game changer because it let you put together your IPO prospectus, which is as some of you might know, a 200, 300-page document, and actually submit that to the SEC on a confidential basis and go through as many go-rounds with the SEC examiner as you wanted to before letting the world know you had plans to be public. And what it allowed, pre-commercial biotechs, preclinical biotechs to refine their story outside the prying eye of public filings. And it also scaled back some of the key financial statement requirements that Brian mentioned. I think, for us, I mean, I don't think I've worked, I don't know how many dozen IPOs over the last few years. We always take advantage of that confidential filing process because it's kind of it's a no-brainer. Now, does the climate at the SEC change, and what do they focus on, and how many comments and how many times you got to go through the SEC review process, and what does that mean for a timeline? Sure, but you still get to do that confidentially, and then kind of pick your spot, so to speak, when you flip public and then hit the markets.
Yeah, no, that's a great Bill. So from a financial statement perspective, it really introduced significant relief for companies that qualify as an emerging growth company or an EGC, commonly used, which basically just means a company that's generating less than $1.2 billion in revenues as of its most recently completed fiscal year. Some of those benefits include, being able to only present in two sets of annual audited financial statements rather than three for other reporting entities, much less extensive narrative disclosure, specifically around compensation. That also gives the opportunity to ultimately defer any changes in accounting standards that the FASB implements. So think of still being able to operate under a private company timeline when adopting new accounting standards.
And how about when do you lose EGC status?
Yeah, so you get 5 years, but you would lose it once you trip the revenue test, or if you issue, I think it's now $1 billion in non-convertible debt in a span of 3 years, or you become a large accelerated filer.
We'll talk a little bit more about that, but June 30th around here is an interesting date. Everyone's watching everyone's market caps. And then how about the FAST Act?
So the FAST Act, that was a subsequent set of legislation out of DC that did a couple things. One, it allowed you to potentially omit audited or interim financial statements that you had a reasonable basis to know were not going to be required by the time you actually hit the market. So as an example, right, if you wanted to get an IPO process started now, you need 2 years of financial statements by the time you hit the market. If you wanted to try to jam an IPO through until, and I use that's the technical term, jam it through, jam it in through before Valentine's Day, before your Q3 financials for 2023 go stale. You would need 2021 and 2022 audited financials. If, however, you knew you were not going to go public until after the staleness date in February 2024, then you don't need to include your 2021 financials, because you know by the time you go public, you're not going to need to include those anyway. So it allows you to basically focus your resources in a more targeted and effective way. The other key point is, when the Jobs Act came out, you had to flip public at least 21 days before you started your roadshow. They changed that 21 days to 15 days, which now means you could, if you say wanted to be public by the end of January, you could flip public right after the JP Morgan conference, which is a big biotech brouhaha. Wait the 2 weeks, and then you hit the road, and then you're public sometime well in advance of the audited financials. And that extra week sometimes can really make the difference, right, between Federal Reserve Board meetings and everything else, right? Having that shorter window is super useful.
I know to us auditors, it's nice to have that relief of not doing a back audit that we know will never see the light of day. So very helpful. And then, Brian, you want to talk a little bit about the benefits of early preparation for an IPO?
Yeah, sure. So I'd say the major benefit here is giving yourself the opportunity early on to identify any critical needs up front. So you really want to take as much time as possible so that you can, pinpoint exactly where you need to maybe remediate some gaps, whether it's in accounting and finance function or tax, what have you. Really going public isn't the end of the journey. It's really just the beginning. So early prep really allows for companies to be operationally ready when they do pull the trigger. I think their early prep actually leads to a higher probability of success when thinking about post-IPO performance as well. I think there's some key considerations that follow this, but when we think about just preparation, it's really, we call it the kind of the three pillars: people, processes, and systems, that you're really going to need to start to think about how all of those play together, how all of your functional groups are talking to each other. But at the end of the day, it's really just a long exercise to really be as comfortable as possible in making sure that you've, that's kind of the no stone unturned as soon as you flip the switch, so that once you hit the ground running, you're not looking back.
And Bill, you want to talk a little bit about the IPO timeline?
Yes. The timelines have gotten longer because the SEC has been a little less, let's just say they've actually started reading these S1s in the last couple of years, which was not necessarily the case in 2020. I kid. So, the way how I advise my clients is, look, in order to do this what I would say the right way and the thoughtful way, you should have in your mind a 6-month-ish process. 6 to 8 weeks of prep, and then 12 to 16, usually 16 or so weeks of kind of being in the trenches, and it could go longer. And so one thing to think about is, okay, how does that play against whatever my, on the biotech side, data catalysts, investor conferences, scientific conferences, how does that play against, how does that map against those sorts of events? Also my cash needs, do I want to go public at a time when, keeping in mind too that all your insiders are going to be locked up for 6 months post IPO. Do you want to go public and then have this great data catalyst that drives the stock price up 100%, and all your VC investment funds who have been there since the beginning are all still locked up and annoyed as they watch all the IPO investors flip the stock and make money, right? So you got to kind of take into account those optics as well. But I would say, it really gets started with the organizational meeting, right? And so it's the prep to that organizational meeting, getting your story together, getting your team together, getting your systems together, thinking about things like your board composition, right? Because there are specific requirements you need in the board of directors rooms from an independence and skill set standpoint. And the last thing you want to do is not be able to go public because you forgot to get a qualified audit chair in place. But working with your auditors and your outside counsel to put together a calendar that makes sense against your operational needs, best you can guess, market conditions and the financial statement requirements and processes there is going to be critical to making sure this is executed the right way.
And Brian, how about, from a timing perspective, the functions within the company? What are some of the things they're thinking about as they approach that IPO?
Yeah, so I think, like I mentioned earlier, it's really a broad organization effort. There's several key activities for each function to essentially execute, leading to the first initial registration filing. You want to make sure like most of that is complete by the time the registration becomes effective. There's obviously going to be activities that are post-effectiveness, such as when you're actually reporting to the street, you now have an investor relations department. You're going to have continued, ongoing financial tax, compensation reporting. The SEC puts out changes quite often, so you got to keep, current with all that. So, I think at the end of the day, it's really just a broad organization coming together. That's really just marching to the kind of the same drum here. And like I said, at the end of the day, you're going to have to build a lot of that skill set and capabilities up in each one of those areas. But that just means you're now a part of kind of the broader organization and not sitting in your silo.
All right. And I think Bill mentioned some of the things in a biotech, things you want to be thinking about in terms of timing, data readouts, cash. Sean, you want to comment a little bit on the tech space of what type of things JP Morgan's seeing tech companies think about when they're trying to time their IPO?
I think Zach will be best to speak about that in the next panel, but I think just to add on to what Bill said from the biotech side, and I think he got it all right, is that you're looking at the catalyst map, and for 6 to 12 months post-IPO, you want to ensure that you have those value inflection points that Bill was referencing, that will entice the IPO investors to buy into the story now as opposed to waiting. But I think also the profile of biotech companies that are going public has shifted from 2021 to today. Typically investors are looking for, companies with clinical data. There's less appetite for platform stories or show me stories. I think they've seen a lot of those technology platforms play out. There are exceptions, obviously, to that, but really the typical profile is later stage companies that have, those inflection points in 6 to 12 months that help investors to buy in. Also, having a clear and defensible use of proceeds story, that's also different today. I think people are focused on the amount of capital that you're raising, where you're allocating those dollars. There's less appetite for those big pipelines and more focused pipelines. They want to see discipline from management teams and boards that show where the dollars are going, what inflection points they're going to get, and what their dollars are going to. So those are just some of the things, and I think Zach can speak to some of the tech considerations as well.
Yeah, I know locally in our portfolio, I think tech's changed a little bit over the past couple of years of, not just focusing on top line in this environment, kind of showing that there's a path to being profitable, but still the things of user counts and recurring revenue streams, I think still play a heavy role in that timing of an IPO. Jen, do you want to talk about, when companies should be thinking about getting their financial statements audited and up to that PCAOB SEC level?
Sure. I think as soon as a company is starting to think, even if it's a little bit further down in the future, about an IPO as an exit strategy, it's time to start thinking about, if you haven't had an initial audit, of getting that out of the way. As you heard, there's a number of things that the company is going to be working through kind of once that org meeting happens, and there's so many streams, and oftentimes what we're seeing in the biotechs and the emerging tech companies is there's only a number of resources within the company. So getting that kind of initial audit out of the way, even if it is kind of at that lower private company guidance, it is really helpful to making sure that you have the right resources and the right information to kind of get through that initial audit. And then it's really looking at the timeline of when is the right time to take those AICPA financial statements and upgrade them to PCAOB standards. So some of that is thinking through, whether or not you qualify as an emerging growth company. So if you do, you have a little bit of more flexibility in what is going to go into those financial statements based on the timing of staleness and things like that. So you might have a better opportunity to only have one back year audited because by the time you're going to flip from confidential filing to public filing, you're going to have another year in place. So it really kind of depends on the company, but also looking at the timeline and the nature of the company itself. I'd also say, it's maybe less relevant from a biotech perspective, but we do see sometimes additional years are needed from a tech company perspective to show trends and revenue growth, profitability improvement. So really thinking about with the leaders of the company of what numbers and what sets of financial statements want to be included to help you kind of develop that story and make sure that you're presenting the company in the best light possible.
And Jackie, that kind of covers the book housekeeping. How about on the tax side? What are some of the housekeeping needs from a tax perspective?
Yeah, it's interesting because we've been talking a lot about the processes, the people, and then there's also the due diligence or the tax due diligence that goes along with your reporting obligation. So, assessing whether or not your department has the skill sets as it is today in the tax department. Do you need to hire internally or hire externally? Use advisors to help you in your process. One of the things that was talked about as well was making sure that everyone has a seat at the table, and tax should be part of that. It will help with you as you're deciding on your planning opportunities as well, overall, and your effective tax rate in the end. But figuring out technology and processes is really key too, because sometimes, as you're going through your growth, your current system might not work with the potential growth that you have. You might want to think about other technologies outside of an Excel spreadsheet, which a lot of companies use in their beginning stages. Also looking at just your process overall. So if you're going to have internal people or if you're going to have external, what's that going to look like from a controls perspective when you start to consider your IPO journey? Thinking through all of that as well as your due diligence. When we talk about due diligence on the tax side, you have to consider what are your disclosures going to be eventually. Do you have enough information to substantiate deferred tax assets? Did you consider whether or not you had an ownership shift, more than 50% ownership shift, in whether or not you need to do a 3D2 study to make sure your attributes are substantiated? Have you done any R&D studies? A lot of startup companies don't do that initially because you're not using them, but substantiating your deferreds is really key here. One of the other things we see a lot of companies struggle with is indirect taxes. So have you done an assessment to make sure that you have no sales and use tax exposure, VAT exposure, goods, duties, and customs? Is that something you need to consider as well? And then on another aspect of it is the stock equity awards. We do a lot of projects on due diligence to assess whether or not the stock equity is still valid when you become public. What is the impacts to the company or the stock award holders? So certainly a lot of tax impacts to consider as you're doing this IPO journey, and something that, like I said, we work very closely with advisory and audit to make sure we're helping on that part.
Yeah, I think even Jackie, you and I just talking earlier and preparing for this, thinking about, a lot of private companies, they're pulling together a tax provision in Excel, for June 30th. Now you got to flip that switch as a public company to get a tax provision done quarterly in that 45 days. That's a big change.
Key, and that's why your resources, I think, are key too. So certainly getting your information from the financial team in the right format you need. A lot of budgeting and forecasting isn't done on a legal entity basis, which is what tax needs. So certainly thinking through that process with your current accounting finance team will be helpful so that you don't hit a quarter and you're like, we don't have the information, it was not ready, and your timeline is right there and due. So,
And to that point, though, we see a lot of companies that are 2 years before they go public doing this internally to get the cadence and muscle memory down. You don't want to try to figure this out as a public company that you can't turn the books at the time that you need them. We see companies doing mock earning calls and just pretending like they're a public company internally, just reporting to teams to see how that process goes. And you'll very quickly figure out what the holes are you have to plug.
Yeah, and drafting that S1 and quarterizing years for the first time can often be a eye-opening experience for management. Jordan, while you've got the hot mic, in thinking about listing agency, what type of things should management be thinking about when they're thinking who to list with?
So we like to put it into 4 or 5 buckets. You should think about your annual costs. So at the end of the day, you pay a fee to an exchange to provide liquidity and services, and you want to look at what the cost is going to be as a public company, because you're going to have all these different fees that come in. Hopefully we're the lowest. But you'll get all these different fees, and you say, all right, well, what do I get for these fees? So when you list on Nasdaq, you get a whole suite of services, you get a lot of marketing opportunities, you get visibility. It's also a great opportunity to engage your employees. So people don't realize how important this is to all the employees that have been there since day one and the ones that have recently joined. It's a big milestone. And for CEOs and management teams, you have full-time jobs as a private company, and now you have a second full-time job, which is being a public company. So I think when you talk to CEOs after an IPO, they don't realize how much additional lift is coming with the IPO. So we try to make that easier. We try to give you the tools and the ability to seamlessly ease the transition. So there's the services piece, there's the cost of listing, and that's based on how many shares you list. If you think about the bigger the company, and then at some point you hit a max fee, and then our competitor, the meter keeps running. So we like to have the lower cost fee structure. There's a great marketing opportunities that we do to help companies tap into that employee engagement opportunity. And then there's really, when you think about just the brand, do you want to identify as being an innovative growth company, a technology leader? And then it's hard to quantify, I call it the goodwill in the balance sheet, what that's worth. But a lot of companies do enjoy being a member of that, disruptive category.
That's great. And in getting there and drafting that S1, that registration statement, maybe I'll open this one up to the panel, but who do you folks usually see leading the charge in drafting the actual S1? How's that work divided?
I'll just say, based on my experience, we often divide and conquer. So the business section, I think, is best handled by the company, right? Because it is your story with direct input from the banking team, and then the lawyers come in and mess it up and all that. But I think to really start with the story that you want to tell, I think the company ought to take the pen on the business section, and you can hire folks or bring on outside advisors to help you. Whether it's from a resource standpoint or an experience standpoint, help you do that. There's obviously the financial statement sections and things like the MD&A, which is the management discussion and analysis on the financial results of the company that is, driven in part by the legal team and largely the finance team. Then there's things like risk factors, which is, all the lawyer stuff, and then some boring stuff at the back of the book around related party transactions, which usually I see outside counsel take the first crack at because we know what the SEC is focused on there. But ultimately, everybody's going to have their hands on the book. It is a true team effort. So it ends up really being a question of who is best positioned to take that first crack at the various pieces from an efficiency standpoint, knowing we're all going to get a chance to review by the end.
And I think I'll just add that the timing of that process, the drafting process, getting on file, is dependent on how prepared the company is heading into it. So from a financial standpoint that people just walk through, from a drafting the business section, from a JP Morgan perspective and a bank perspective, we spend more of our time just on the business section. And that can comprise 4 to 6 weeks of multiple drafting sessions per week that can be 4 hours in length, and requiring turns in between each session. So it is time intensive, requires a lot of management's time, and that's just one section of the S1. So there's obviously other sections that need to be filled out, financials taking a large part of that time. And, we try to coalesce the timing so we can get on file in the timeline that people desire, ultimately trying to back into a potential launch timing. So it is a time intensive 4 to 6 weeks that people are driving forward.
Yeah, I appreciate you mentioning that, backing into the timing. Often we get the question as auditors, when can you be ready for the S1 to be filed? And usually my reply is, when will I get to see the S1? And often there isn't an answer to that right away. Brian, you want to chime in there?
No, I was just going to say I'd echo all of the same. That's why it's really important to make sure you've got really strong project management going so that you can keep, all of those different sets of groups accountable to your timeline. So, but yeah, I'd agree with all of what was said.
Yeah,
I'm still trying to understand the national office review period.
So are we sometimes. I won't look at some people in the corner over there. And then, Bill, do you just want to talk a little bit about publicity and gun jumping?
Sure. Just this is a legalistic issue here, but it is an important one because if you trip on this, then you might get put in the, not to use another sports metaphor, the proverbial penalty box for a while. But basically, there are rules and restrictions around what a company can and cannot say in the run-up to their initial public offering. And without getting too far into the weeds here, a couple of things to keep in mind. The closer you get to actually hitting the IPO roadshow and trying to be a public company, the more restrictive those rules get. There are varying degrees of risk tolerance among lawyers and bankers and management teams on this. So, there are no clear black or white answers in many situations, but you do need to have a full conversation with your working group from the minute your organizational meeting happens all the way through the IPO process. So going into your org meeting, knowing what your plans are, kind of what your ideal plans would be from again, investor conference, scientific conference, publicity, press release, interview media standpoint is going to be important. And then also looking a bit at what you've done up until that point, your kind of ordinary course of business, prior practice, it might be helpful in giving yourself some more flexibility post-org meeting. So talking to your lawyers well in advance of an IPO process to get a sense of, okay, what can I be doing now to give us more flexibility, knowing that it's going to be a group conversation once you've convened your working group for the IPO.
All right, great. Well, thanks, everyone. I think we'll switch things over to what happens after that IPO.